Welcome back to Yuri's Box. In this video, I'll be giving a quick update to TLT. We'll be looking at the PMIs that just dropped a little under 2 hours ago, something like that. Also, a look at the latest early benchmark by the Philadelphia Fed. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So, first things first, this was kind of a weird, PMI report. Mainly because the main theme of this report was that basically we continue to see, even in June, tariff front running. As kind of weird, as it sounds, that is basically what the PMIs have, and this report has been pointing towards. All right, overall, continue to see activity continue to grow in June, though the overall rate of expansion lost a little momentum to remain well below those seen late last year. And again, this is just pulling back the idea of, that I've been a proponent of for quite some time. That again, we're in the current state of the economy is less consistent with what we saw from September to January, and more consistent with what we saw from, really last summer. All right. And this is kind of, hinting at something like that. Regardless, you continue to see, tariff related inflation potentially, in the pipelines. At the same time, this is really what, strikes comes out, in particular in this report. Companies, meanwhile, struggle to meet rising workloads, with backlogs of work increasing at the fastest rate for over 3 years, and encouraging firms to take on additional staff to the greatest degree for a year. All right. However, the confidence in the outlook deteriorated slightly. Now, this, there's something a little bit further down that actually, catches on to this, and we'll read it in a little while. If you go further, June saw further inventory building in manufacturing. Purchasing of inputs was expanded at the fastest rate in 37 months, causing inventories of inputs to also rise again, increasing the second fastest rate in over 3 years following May's survey record rise. Again, more price inflation rhetoric right here. Price pressures rose sharply. Steep increases commonly linked to tariffs. However, prices also rose sharply in the service sector, likewise often not attributed to tariffs, but also reflecting higher financing, wage, and fuel costs. Again, potentially playing into the theme of higher oil prices in the month of June. Again, the survey for the PMIs is, if I'm not mistaken, between the 9th and the 20th, something like that, 12th and 20th. So it's actually right smack in the middle of this surge in oil. Funnily enough, take that for whatever it's worth. But regardless, companies meanwhile struggle to meet rising workloads. I think I already read that. Here we are. While trade worries and anxiety around government policies have moderated since April, companies generally remained less upbeat than prior to the inauguration of President Trump. Right. In contrast, manufacturers grew slightly more upbeat, in part reflecting hopes of greater benefits from trade protectionism than service sector counterparts. Again, this is they often throw this in. They like to throw this paragraph in about how manufacturers are a little bit more upbeat because, again, they see the effect of tariffs leading to more job creation, factories coming back to the US. While it is important to underscore that, yes, that is definitely something that eventually could happen, it isn't immediate. It's not like we have factories popping up like mushrooms from a day to the next. It takes time, and ideally you'd also want a clear framework, right? You don't want policy shifting one day to the next, because again, we're not talking about $10 here. We're talking about billions. The money that it takes to make and open a factory in the US. And again, looking on to capacity and employment, companies took on additional staff at a rate not seen for just over a year, largely in response to the need to meet higher workloads. A 12-month high rate of job creation in manufacturing was accompanied by a 5-month peak in services. June saw the largest accumulation of uncompleted work recorded for 3 years. Higher work outstanding in services work were accompanied by the first rise in manufacturing backlogs since September of 2022. And again, more read on companies' expectations remaining kind of dim. But regardless, I think that as usual, the summary offered by Chris Williamson is often the best way to characterize the report as a whole. And as the commentary suggests, the June flash PMI data indicated that the US economy continued to grow at the end of the second quarter, but the outlook remains uncertain, while inflationary pressures have risen sharply in the past 2 months. Furthermore, while domestic demand has strengthened, notably in manufacturing, to encourage higher employment, this in part reflects a boost from stock building, in turn often linked to concerns over higher prices and supply issues resulting from tariffs. Such a boost is likely to unwind in the coming months. And again, this kind of ties back quite well to this part right here. Companies will struggle to meet rising workloads. It's kind of weird because, again, you'd expect that by June, we're effectively with a 55% tariff on China, as well as, I've lost track on where we are with with the EU and the rest of the world, meaning we have tariffs now. Right? So if you had to front run the tariffs, probably time is up. Regardless, this is what the PMIs seem to hint at. So, at the very least, how I treat the PMI reports is kind of a sneak peek into the next non-farm payroll report, and potentially you could expect an upside surprise to employment. Now, again, as the commentary here at the end suggests, it's probably mostly due to the tariff front running. And again, I remain of the idea that I'm quite surprised, to say the least, because to me, if I have to act in you have to be cynical. To me, it is just a reflection of what we've been seeing so far in the month of June. We've been unable to really pinpoint where the economy is going. We have really, collectively, as analysts are concerned. And so we're just kind of bobbing around inflation risks and slower growth. And potentially this PMI report is just, if you will, a rationalization of what we're seeing. What was it? Tariff front running. Good enough. I'm a huge fan of the PMIs, but who knows? The non-farm payroll report could actually be a beat, a good beat. And we shouldn't discount it just because it sounds weird. Regardless, to me it sounds kind of weird because, again, if you're front-running tariffs and tariffs are here, all the front-running ideally is behind you. If you're purchasing now with the tariffs, you're not front-running, you're just stomaching the tariffs. So I'll think about it for a couple extra days here and try to go over it a little bit more. Do leave your thoughts in the comment section, because this is one of the perfect examples where there's a bit of something for everybody. All right, if you're an inflationista, you have the prices section to go through, and you'll have plenty of clues there for you. If you're kind of bullish, you have the fact that manufacturing seems to be doing quite well. All right. We rose from 49.4 to 51.5. If you're concerned about growth like I am, there's again something for us too. Potentially looking through this potential momentary bump, as it's likely to lead caused by tariff front running. But again, I reiterate, I'm not so convinced about it because it just doesn't compute in my idea. We will likely see goods inflation come at some point. To me, that will come when we work through all the inventory that we built up in the last couple of months, as we anticipated, and we were pulling forward all of the demand before tariffs came along, right? So I think that inflation is still potentially ahead of us, and all the things that I've been saying about how I'm thinking about inflation rather. So that's really the PMIs reports, the PMI reports for you. There's a bit of everything. Again, do leave your thoughts in the comment section. I'm honestly, I really don't know what to think about this report. This is the first time that I've read a PMI report, and it kind of leaves me, again, baffled, if you will. Last month, if I'm pretty sure it was last month, we went from the worst case scenario to something more manageable. So then you could kind of see you could kind of get why you'd see, the PMIs be a little bit more upbeat. April was bad because, of course, it was going to be bad with the Liberation Day, Obliteration Day, call it whatever you want to call it. From January, February, March, we saw the slight decline, the return to the slowdown environment, which was, again, not surprising. To me, again, just to reiterate how potentially surprised I am, this, again, is the first report that really leaves me kind of baffled. So I'll go over it in the, I'll give it an extra thought in the coming days. So that does it for the PMIs. One other thing I wanted to mention, just quickly before we move on to TLT. On June 20th, we got the early benchmark revisions that comes out from the Philadelphia Fed. And we actually get this, with quite a delay. This data right here is from Q4. I'll leave the, if I remember, I'll remember to, leave this link in the comments, in the description of the video, so you can go and have a sneak yourself. So, and why is this relevant? Because this is part of those huge revisions that I often talk about to the non-farm payroll reports. Again, when looking at the headline number that comes out each month, that is most likely not going to be the final read on the non-farm payroll report. Okay. Usually what you're going to have is, again, 3 rounds of revisions. And after 2 quarters, you start getting these big revisions. All right. If you remember, last year around August, we got that huge, down revision by negative 800K jobs. And that was a result of the QCW, again, revisions. And again, the first hints that we can get is, to how, the QCW will come out is, again, looking at these early estimates by the Philadelphia Fed. All right. And this report is structured a little bit differently compared to the others, but regardless, I'll leave this table here for a second. I'll just freeze the screen here, so you can potentially even stop the video and go through them yourselves. The numbers on the left side of the preliminary read of job growth and percentage change by the the census current employment statistics. I got that right. Employment statistics, yeah. And the number on the right side is the early benchmark revisions potentially. So I think there's Arkansas. Regardless, I'm pretty sure this is Arkansas. 5.1. The revision seems to be pointing to slower growth and job gains. And there are some upward revisions. I'm pretty sure I saw them right here. Right here, LA. What would that be? Oh man, I suck on my US geography. I mean, really, I'm not stuck on my geography. I just don't remember the the abbreviations. I can already hear you. Aren't you supposed to be European? You're supposed to know geography, man. Yeah, I know. Regardless, you can see for yourselves there are some upside revisions. All right, right here as well. Tennessee, I think this is right here. Texas, Utah is lower. Um, Overall, Wyoming, Wisconsin lower, West Virginia. I'm trying to compensate for the for all the ones I didn't read here. New Jersey slightly lower, New Mexico lower, New York lower. Again, most of the states have lower revisions. All right, so as pointed out here as well. Early benchmark estimates indicate that the employment changes from September through December of 2024 were significantly different in 11 states and the District of Columbia, compared with preliminary state estimates from the BLS current employment statistics. Early benchmark estimates indicated lower changes in 10 states and DC, higher changes in one state, and lesser changes in the remaining 39 states. So most of all, overall, you have a majority of states not seeing huge revisions. A few of them do have potentially bigger revisions coming on. All right, New Hampshire, right here, the preliminary estimate was for 4.2, and we got down to 0.3 of a percent increase. All right, so again, hopefully, I kind of compensated. Oh, Ohio, I recognize Ohio. Okay, I'm kidding. But regardless, you get the picture. It is still the same labor market. It is still the same data that we've been getting. It's still pointing in the same direction, lower. Do tariffs help? No. Does geopolitical risks rising help? No. So, the current state of the labor market I just went over earlier today, it is roughly the same. So again, my outlook rather on bonds stays quite similar. It really hasn't changed that much. Today's been quite weird because again, as I pointed out today, we were likely to bob around between the economic data, having an effect, and geopolitical shenanigans going on. All right, so for instance, today we had the PMIs come out, and TLT just kind of took a hit. But as the day has been progressing, we've actually read some headlines that potentially we're looking at potential strikes by Iran on Qatar, on US bases in Qatar. So I think that overall we'll continue to bob around between facing the economic data and geopolitical risks. We saw something similar happen in the dollar. Actually, the dollar potentially was more a reflection of the PMIs. As the PMIs got released, we saw the dollar really start to suffer. And this is really a tease for me because I've been pointing at the fact that potentially the next one of the next trades, potentially another idea, is that yes, the dollar might continue to go lower, but if you look at history, potentially what I've been pointing out is that usually when you start to see this trade, this malicious trade, if you will, play out, where you have the dollar going lower and yields going higher, eventually, with time, you start to see the opposite take place. So a higher dollar and lower yields. And for about 10 minutes, we actually got that. And I was starting to say, that's nice to see. And then, the PMIs came and the dollar just kind of lost most of its gains. So overall, we'll continue to see how TLT reacts. I think that most of this the gains that we're seeing today across the yield curve mostly tied to the geopolitical risks rising. It'll be curious to see how TLT evolves and how again what the market perception really is, because what I'll say is that it is definitely good news that it is good news, welcome news to see bonds perform as the risk-off asset they are. All right. Again, not because I've been particularly worried even during April, and I would have had plenty of reasons to be worried in April about that. Simply because it's a very popular narrative that bonds have lost their safe haven status, and the world is going to look at alternative assets. I'm still quite skeptical on that. I just think that these narratives, again, as I've been saying for a long, long time, are mostly due to the fact that we haven't lived through significant geopolitical risk in quite a while. Rather than significant, a proper business cycle. I think that it is a combination of the two, and if I had to put either one on in the first place, I would put the fact that it's been so long since we've have to live through a business cycle that I think that potentially we're losing track of some things that history has taught us. But regardless, we'll see how things play out. It is definitely not the time to wave with a green flag and call going on for victory laps, if you will. So overall, PMI is kind of confusing if you ask me. We continue to point towards tariff front running in June when we have 55% tariffs on China, tariffs on the rest of the world. It doesn't really seem like the best time, to be front running tariffs. When you have tariffs, ideally you'd like to front run the tariffs before the tariffs, but regardless, again, you can leave your thoughts in the comments section. I'll definitely, keep your considerations in mind as well, because again, weird. It was just weird to me, but regardless, throughout the report, it continued to point towards, employment going up. All right, so if that's good news for the economy, no doubt about that. Let's take it at face value. Good news for the economy. Workloads going up, and prices going up for companies. All right, so if I had to put a label on it, I would say this was more of a win for if you will, the inflationistas. But again, I'll defer to what I've been saying throughout this video. So that's it for the PMIs. And again, to summarize, we went through the early benchmark by the Philadelphia Fed, pointing at mostly unchanged revisions coming for the fourth quarter, although there are some states that are likely to see big revisions, and you can see those highlighted in this beige, caramel color, if you will. All right, and as far as TLT goes, we continue to bob around between having to consider economic data and geopolitical risks. All right, by the time I finished talking, I turn on the TV, Iran might have struck Qatar, and it might be China might be getting involved. I have absolutely no idea. Hopefully not. Again, as much as I want TLT to pump, I want it to pump so that we can all enjoy our gains. Right? You either want to have a pile of cash hiding in your bunker eating canned tuna. All right, so I'll leave it at that. If you like this kind of content, consider leaving a like, subscribe to the channel, and I'll see you next time.